Good morning. We are Mortgage Pros 411. I'm Audrey Boissonou and my co-host Kevin Casey. We are joined today by Bill Dallas. Thank you so much for being here, sir.
You're welcome.
We're going to start off with a couple of little announcements. The first one is I'll be in Calabasas. I had to think about how to say that properly on Thursday for the camp Christmas party that will be held there. I'm looking forward to it a lot. From 5:30 to 8:30. It is being hosted by Greater Ventura in North LA with Peaches Jensen and Ron Henderson, and it'll be a live band, Ron Henderson's band. It'll be fun. So anyway, I hope to see people there. Also, we have Coach Katie, who we've had on our show a couple times. She has a coaching program that she's starting. So it is very, very affordable. And people, we need to absolutely be planning ahead, starting our plan now. We've been talking about this since October. You should have your 2023 plan put together already and be implementing it. There's no reason to wait for January 1st, right? So make sure, go to our website. If it's not there already, it will be today. And I also wanted to make sure that you noticed the NAM call to action that we had mentioned. It's on the website too. You can click on it. It takes you like a couple of seconds, no kidding. And it is encouraging FHFA to pull back on those cashed out LLPAs that are not particularly helpful to the current environment. Can we agree on that?
Yeah.
Well, make sure, please, just go to the website, Mortgage Pros 411. We also have our YouTube channel where you can look at past episodes. And also our Down and Dirty and 30 is going to be ARC on Thursday at 11 o'clock, 30 minutes of a program, product, or idea in and out, and we'll have Louise Woods and George Ramirez joining us. So with that, that's a lot. Okay, so let's get going, shall we? So let's talk first, Bill, just because it's imminent tomorrow. We've got the Fed meeting. So it'll wind up tomorrow afternoon. They're going to issue a statement, which always, hold your breath, because that's where it all goes to CRAP occasionally. We're expecting a 50 basis point hike versus the last 4 hikes of 75 basis points. So what do you think? Good?
I think you've reached a tipping point finally, right? So Kevin, like all three of us were talking a little bit before, interest rates going up as fast as they have really is the topic, right? How do home buyers and sellers sort of make sense of that in a downturn? It's so the contradiction is confusing, and that's basically shut off the spigot. I think the Fed is feeling that. So the I word is going to be replaced with the R word. So inflation versus recession. And I think what you see in a recession, you've already felt, right? The 100-point, you go from 3 to 7, shuts off everything. Consumers are stunned. But I think the two things that I would mention that might be a little bit interesting would be the spread between mortgage backs and treasuries is extraordinarily wide, and it never is. That's an indicator that you're moving out of I to R. And the second is a 2-year and a 10-year being whoppered, right? So the 2-year treasuries much higher than the 10-year. That's never happened ever.
Not supposed to happen either.
Yeah.
No.
Right.
And so that, I think, then trickles down to us as loan officers. And when I was like with each of you, when I was a top LO at First Franklin or trying to drive my own business, like we said, when you get into these moments when I think it was Audrey and I talking, when I started in the business, the market size was 100 billion.
Yeah.
Now it's now a shitty year. We're going to have a shitty year at 2 trillion.
Yeah. 2.26 this year. They're forecasting 2.05 for next year. That's MBA's forecast. And of course, it's lower than it was in 2020 and 2021. Those were not normal years. But look at that. There's still $2.25 billion of business this year while everyone's crying poor and saying there's no business. So how do we reconcile that, right? There's business out there, and there will be next year too. We have to go get it like salespeople this time. It doesn't fall out of the sky. The phone isn't just going to ring endlessly. Your emails aren't going to be backed up with people going, please refinance me immediately. No, you got to go work for it, right?
And you got to
No,
push
and
them a
they're,
little harder too.
You what?
You
yeah,
gotta push them a little harder.
push a little harder. But I think demand, I mean, this is a temporary seize up in, the entire process, right, of demand. But demand had been seized up for a long time.
Right.
I mean, if you look at supply, I mean, I'd say the headlines have always been the thing that just is almost, I can't even come to grips with the low supply that we've had over the last 2.5 years.
Yeah.
Mhm.
I mean, a normal market might be 2 million listings and we have 600,000 listings. You wonder why prices go up. So now if you're a buyer, come on, this is it. Low supply, lower home prices, lower interest rates, lots of equity. People are going to sell and there are going to be opportunities for you. And this has to be the time as supply sort of ramps, prices fall a little bit. And this is a good time to be a buyer. Well, they'll say, well, interest rates are too high. Hey, interest rates are going to get lower.
Right.
And maybe you can do buy downs. It's
Yeah.
like that book Tim Brahim and I wrote on strategic financing. It's not rocket science to do what Rocket did. To do a 2.0 or 2.1, and you can offer buy downs and have the seller pay for it.
We did a
Right.
session last Thursday with Terry Buckman on the buy downs and how to use them in your business. And it was great. So again, that's on YouTube if you want to go back and reference it. And she also did a nice presentation on the difference between 2008 and now, which the realtors are hungry for this information and share it with your borrowers because they too are seeing the headlines, and the headlines on their own will just scare the crap out of you because they're just so overinflated, misleading. I mean, my favorite one of the year, which I'll never forget, foreclosures up 185%. And I'm like, yeah, from a foreclosure moratorium, right? Like, it's like you have to read into it, but most people don't, right? So it's our job to make sure we're translating those terrible, ridiculous headlines into what the reality is, because people are really convinced this is, they're waiting for the good deal to come. They're waiting for a crash. You know what I mean? Like it's.
Well, I keep telling people when they say, oh, the rates are too high, I go, yeah, and that's great. Do you know why? How do you take advantage of that? You're buying now, and when the rates go down, which everyone's predicting, home values will spike. You can refinance. Now you have a home that's worth more, and you're going to be paying less. You buy a house when rates are low, you never get to refinance and lower your payment. You're just stuck with that payment, and you can't take advantage.
Well, and I don't think you're going to compete. I mean, I don't know about you guys, but I've been doing it for 40 some years. I've never seen a market, in any market that I've ever been in, when cash purchases was probably more than 1% to 5%.
It is. Okay, so here's an interesting note. Ready? Core logic. 37% of all homes are owned free and clear. I thought that was astounding. So there's a tremendous amount of equity. And we had talked about this before, where in 2007, the average equity position was 19%. And today it's 56%. I mean, those are incredible differences. Go ahead.
And that's where I think, Audrey, I actually think that is cash out is what's going to happen.
Mhm.
And so you may think that, well, obviously when rates drop and everybody runs to the turnstile to hit a bid on a 4 going to a 3 going to a 2. I mean, is that fun? No. I mean, you make a little bit of money, but it's a pain in the ass. If I was a buyer, you just sort of avoid that. And what happened to buyers was if you were a normal buyer, and normal being, I have to sell my own home, or I'm a new first-time home buyer and I have to accumulate cash. Those people were just out.
Yep.
They were in line. They were 16th in line.
Yep.
Right. So I think the message when I was doing this, I always said, well, what are a few thoughts and things that we can do to compete as an LO right now?
Mhm.
And I think where Kevin was going is where I always went, is you have a tendency to market yourself out of business with your pipe. Whatever your pipe is, you close it out and then you go, woo, I got to go run and go do something. Well, this is the time, I think, to really, in creating your 2023 plan and 2024 plan, this is all about relationships and conversations.
Mhm.
And you've got to have conversation tools that are conversation starters, maybe not finishers,
Right.
with all your customers. And
Exactly.
I think the conversation that I'm having with customers today is really how to build with loan officers, how to build your database. And I do that with home buyer seminars, whether they're home, I have this 50, 60% equity. How do I take it out? What's a reverse? What's a shared equity loan? I mean, I don't think people have even seen HEIs before. I mean, we had them back in 79 or 80, but an HEI or an HEA and a HECM, I mean, if I were taking equity out, I wouldn't want a payment.
Mm,
So how do you do that? Right?
Yeah.
Okay. Is that a conversation starter?
Yeah,
Yeah.
absolutely.
it is.
Is it a finisher? Maybe, maybe
Right.
not, but I can have a seminar, I can have a discussion. And I think that's what we want to try to do is there's always going to be 10 to 35% of the market that has to do
Yeah.
something.
So just to looking at some of these comments, we have a comment from Tina. She said, "Wow, I worked for Bill when I was 18 at First Franklin." Her name.
Me too, Tina. I was 18 at the time too.
Do you remember? So, and Jill is commenting that Fannie didn't help with their negative appreciation forecast for 2023. But can I just state for the record, we've decided this year that all the forecasts are total bupkis. I mean, nobody called this year. Nobody. Like maybe you can call like what the next moment might sort of look like. But if you go back to December of last year and all of the forecasts for 2022, nobody saw this coming. Like not at all. Right. So I think at this point we focus on, all right, here's where we are today. And this is what we do next. And we just get back to the business of doing business like we used to. Right. And of course, there's going to be, we were going up, 300% a month for a little bit there in 2020 in terms of volume.
That's unsustainable.
It was hiring frenzy. It was completely out of control. So of course it's going to moderate. Of course there will be layoffs. Of course, right?
But that's a great conversation starter, layoffs, because you say, hey, who do you know who's worried about getting laid off? Do they need to take cash out now so they can survive if they do get laid off? Great conversation starter.
Or how secure do you feel about your job? Like, and the other thing we had talked about too was those HELOCs. I mean, we all remember, or a lot of us remember in the meltdown, we don't call it the Great Recession here, Bill. It was the meltdown because there was nothing great about any of it. So anyway, but they were closing HELOCs without any warning whatsoever. And so we keep telling people, like, if you're taking a HELOC out and you're going to need that money, you put it somewhere else. And you're going to pay for it, but at least it will be there if they start doing crazy, So
well, what's interesting too is you didn't have payday loans, you didn't have personal loans, you didn't have this whole movement of buy now, pay later. I mean, you've got an underbelly that creates, I think, refinanceable events that we didn't have before, right? People use, I mean, they didn't have credit cards really. So now you've got swipe left, swipe right, you can get a credit card, you can borrow money, you can do all these things. So you've created a bubble, I think, in debt that only equity out can take care of. And like you guys were saying, I do think Fannie and Freddie aren't our friends in some cases, right? Because they always restrict the thing we need the most. And they restrict it because they potentially see a bubble coming and they want to, so where do they start? They started with non-owner occupied and just whacked that business. Well, that became, I know at Finance of America, that was probably 35% of our business. Right. So, and that's telling you, I think, occupancy and occupancy fraud, what to do with second homes, what to do with ADUs. I mean, the single family residence is not, the borrower and the residence is FUBAR compared to what our guidelines and rules were built for in the 60s, 70s, and 80s. Because your borrower, there's multiple occupants,
right?
There's multiple borrowers, and there's multiple jobs. I have to have guidelines that have employed and self-employed guidelines for the same customer,
Yes.
because they have an employed job and they have another. And then I've got a house that was a primary residence. I mean, remember those days where we talked about primary residence and a second home? Nobody had one of those. And an investment property. Well, now you've got a person living in their home, right? They're renting out their home
Yes,
simultaneously, and they probably have an ADU or something else where
Yeah.
they've maybe restructured their home all at the same time. And oh, by the way, they work out of their home.
Yeah.
Right.
So you've got a whole set of guidelines and rules, and non-QM doesn't fit it yet. It's trying to, but that
Right.
market is all messed up. The agencies are restricting it. And so here we sit, look at the size of our files.
yes,
I mean, the bullshit that we ask for about income and all of that stuff is what we're trying to fit a round peg, square hole. And what's happened is this thing is out of the bag.
right,
You
So
know,
you asked me before sort of what I was going to do. The number one thing that we can do is a 30-year fixed rate loan is FUBAR, and so are these underwriting guidelines. So you've got to have a product that fits a customer when they look at it.
right. Well, so I keep saying we need to throw all the guidelines up in the air and start all over again, because
We do.
they are so out of date, out of whack. They do not at all. So we've been saying the same thing. I'm really happy to hear you saying it, because I
you've been
believe
saying it
that
for a while.
it needs to be the way forward. We need to really look at it and go, okay, this doesn't fit where we are anymore with employment, with living situations, with anything. And so let's be honest about that. And then as far as the LLPAs, which they used to swear had to do with risk, I mean, which I've literally gotten into arguments with reps from the agencies. I'm like, not arguments, let's put it a better way.
That should beats them up.
I just disagree politely, I hope. Anyway, bottom line is, if you're telling me there's more risk on a cash out refinance at 20% LTV than there is on a purchase at 80%, come on, show me the algorithms that taught you that, because I don't believe you. So,
Well, and what we learned, I mean, I think if you go back to, because they to your point, the risk models that were built years and years ago by most of these companies, and so the whole world that we live in is built around debt to income and credit. Right? Basic credit score. Well, now a credit score, I mean, we already know Vantage scores are better than the 5 or 6 revisions of the old FICOs that we had. So I think a person's score is indicative to their performance going forward. Right? So now you look at DTI. Okay. Ratios, and I'm going to say this, through the dawn of time, debt to income ratios have never been predictive or correlative to default. And the reason that is true is because when you lose your job, you then go to 0 or 100%. Right. So I think what you should be doing is trying to look at customers that have equity. And then when you look at a purchase, I mean, Fannie Mae and Freddie Mac's job really is to do high LTV purchase. That's what Ginnie Mae was created for.
Right.
VA was 0 down. FHA at Finance of America, 30% of our business was our purchase business. 30% of it was low to no down payment with a bond loan.
Wow.
30% were bond loans?
Yeah.
Or
Wow.
We had hundreds and hundreds of bond programs. And in California, you just don't, you're sort of an anomaly to some extent because you have so much equity and home prices are so high and everybody was competing for cash that you didn't see it. But if you went into any major city in California, it's no down payment, bond.
Wow.
And that's a tough road for a consumer because they have a first and they have a second. In some cases, they even have a third. with the bond lender. So my view is trying to, I think income, we've got the bright line that was created with Dodd-Frank around 43 DTI was what they meant to say, I think, is income is important and other sources of income are important. And what we should be doing is really, because if I'm making a loan to a new first-time home buyer, especially one of color, right? I want to be aggressive, and the world wants you to be aggressive, and yet the guidelines are scaring you to death. And oh, by the way, most of the companies that I work with are repurchasing loans left and right.
Yeah.
Already.
Well, yeah. That's a whole thing. So MBA has sent a letter to FHFA asking them to increase the AMI for the Home Ready and Home Possible programs, which is a big deal. And hopefully they do, because it's not working for most, I mean, certainly not in our area for the most part. And so it is, but I think it needs to be a balance between, yeah, we want to get people into homes, but you've got to do it responsibly so that they can make a payment. And so if you're pushing the DTI, you better know that they've got, some income,
some asset.
Yes, that you're not able to count, right? So like if you're, you see these DTIs, you're like, oh, they were 50 something. Well, they hopefully they have someone else in their house who is making some money that you're not counting in the DTI, but it's helping them, take care of everything. But again, I don't know how we're going to get the establishment off of these are the rules, these are the guidelines, this is how we do it, because it's a monumental task, I would say. And we have been doing things the same way forever, but I think we've got to. I mean,
if you recall, even I spent at First Franklin Anadona, I spent 15 years of my career never selling a loan to the federal government. That just means you have to have a functional capital market, and we don't. I think what's interesting is we have a commitment, I think, on behalf of almost all Americans to move Fannie and Freddie into a private securitization market. And that's what everybody wants to do. What were you quoting me before? How much profit were Fannie Mae and Freddie Mac making? A ton. Right? So
third quarter, hang on. Because I've been wondering about this. I finally looked it up. Third quarter, Fannie Mae in 2022 made $2.4 billion net. In third Q3, and Freddie made 1.3 billion in this market. Like those,
that's not how many loans they did. That's how much they made.
Net, okay, net, not gross, net.
Net.
So I'm and by the way, I don't necessarily agree that Fannie and Freddie should be privatized just because of what we saw when the pandemic hit. And the secondary market goes away completely for everything. If they're, like when you don't have, the only thing that kept us going at that point were the GSEs, right? Jumbo went away in 2020, non-QM went away. It comes back, but you've got an entire market that just disappears. And how do we do that and have a privatized Fannie Freddie?
Yeah,
Explain, please, Phil, explain.
Well, no, I don't. I think you're right. I think what happened was you had you never had a regulator for just Fannie and Freddie. Then you do, right? So you have FHFA. You have one guy who basically can change the course of mankind if they want.
One woman, but okay, keep going.
Now, right? One. Yes. And so when you look at whether it's Sheila or whether you're looking at any of the groups that, when you look at it, you look at the agencies, I think, provide a vital part of the market in those times. And their job should be to provide credit enhancement, which is really what they do, to private securitization so that private securitizations can work in those kind of markets.
Right.
And so the capital market side of whether it's banking and all of that, so you want these innovations. Right. You're not going to get innovations in a market that is basically as old as Fannie Mae and Freddie Mac is. 100%. I think Jenny Mae's point is that, hey, we're over here for doing that today, where we provide an enhancement to issuers like us to securitize through the government a high LTV and other product. There's no reason that Fannie Mae should skim off the top and get all the good loans at high FICO.
Right.
Right. So how do we do that should be the conversation. And we want to actually get to underwriting guidelines that actually are current so that it fits our gig economy. It fits, the oddness. I mean, we're in real estate, and if we wanted to use rental income or income from Vacasa or income from Airbnb or income from a roommate, just everybody raised their hand if they had a roommate and they paid you something. Yeah, everybody. So why can I not use income? So what we've become good at coming out of the malaise of the meltdown was we can find all your obligations, and we really suck at finding income.
Yeah, 100%.
And that is killing us.
Because if you look at the stats for the housing and across the country, the cities that are down the most right now are the ones who are not Fannie Freddie lenders or loans. So San Francisco, Seattle, San Diego, Denver.
What about Austin? Austin's Fannie Freddie all day long.
Yeah, well, that's not on the list.
Close.
High declining.
It's getting. Texas is different, right?
Yeah.
Just because of the constitutionality of. I mean, Texas didn't get slaughtered it was the only state in the union that was flat.
In 08, yes.
Right. And that was because
they got equity.
Yeah, it was unconstitutional
to
take out equity, which is actually un-American.
Yeah, I know.
Yeah.
I have equity. I should get my equity out or be able to do something, even if I impale myself.
Yeah, the reason behind that, though, is Texas is a big boom and bust state with oil. And so every time there was a bust, they were finding that people were, tapped out and they would lose.
They were having to bail them out. Right.
Yeah. Okay. I just had a Tesla thought that I'll just leave it. Okay. So we have a comment here. Don't you think the unknown here is the economy? Housing will be fine, but the decrease in access to cash and credit cards maxed out, layoffs. I do think tremendous opportunities for buyers right now, but I am optimistically cautious on what's to come. And yes, we know that recessions are actually good for housing unless we cause them, right? So other than 2008, which was caused by housing, amongst a few other things, every other recession, housing has done well, right? So I'm optimistic for housing, but again, I think that as an LO, you have to really be focused all the time on, can your borrower make the payment? What is their plan B? I mean, if ever we were made to understood why we need to have reserves on investment properties, you don't have to pay your rent moratorium during the pandemic drove that point home, right? So can your borrower make the payments? What are they going to do? If, how secure are they in their job? These are conversations we should be having with people. Mm-hmm. And it's yet another reason why someone should come to you instead of pushing a button, right?
It's so true, because it's not, I think just the sheer size and torture that you go through to try to get a loan approved today, with all the income requirements. I mean, like I said, when we started measuring the size of files coming out of 18, we went from thin file with 2 things in it and a mirror where if you fogged it, you got the loan, to I have cascades of information. I have thousands and thousands of pieces of information. I would say half of those have something to do with disclosure,
100%.
or HUD's. What I would say would be the change between an LECD and the challenges. I mean, you guys, it's so hard today to even walk through, forget HIPAA and privacy and all those things. Then you move into all the requirements that you have to have in terms of disclosure. And then those move into all the things that you have to do to make sure that you didn't bait and switch or change. All of that has created this mass. The cost to produce of a loan was $2,000 in 2000. It's $13,000 right now.
That's crazy.
And we're at full throttle.
Yeah.
And we've got, back then, our volume was low. today. So I think we have to rethink, and that's why I think originators, look, you're the lowest cost producer in the chain, in the food chain, on your own. You really are, right? Because you can, if you are an independent mortgage broker or you're an independent, your cost is zero, or your cost is whatever your cost is.
Yeah, that's why everyone's keeping
cost-
the loan officers right now, but they're letting go everybody else.
And you're seeing people in retail struggle. So all the retail companies have created net branches,
Mhm.
and all those net branches look fascinatingly like a brokerage, except they work for the company. And those things, those costs are really very, very difficult and unsustainable, because you load up, the companies have to back your insurance, your comp costs, they have to have salary, they have all your space costs, they have leases, all of that. So all of that's loaded into this massive cost. And I think it's almost tipping over on itself today, because it's not sustainable at 13,000. And what does that do to price? My price on the loan has to be higher to pay for all the shit, right? Versus if I'm over here, my price is lower. So I call that skinny retail or brokering, where I don't want all this loaded cost. I need a good price, a fair price, a quick price, something that is a competitive price. And could I get that with United Wholesale or Home Point, or pick your lender, investor? There's always a United Wholesale and there's always a Provident. Right? There's somebody leading the charge, pissing everybody off, offering a lower price than anybody else. Who cares?
Yeah.
Take advantage of it, right? As an originator. But the skinnier you are, and that's what Kevin was saying, I just want a loan officer to get to the price, and I can price that deal and make a profit. The moment I load up all these other things that we've got to have, does the Tesla run any better than your 1967 car? No. It probably has a lot more restrictions. It's probably cooler. I know I have a screen, but when I open the front hood of a Tesla, there's nothing there.
It's the trunk,
right? There's a trunk, or it's a Yeti, for Christ's sake. And when I open up the original combustion thing, at least I know what's happening. So we're at this point when stuff happens, and it generally happens out of necessity, because people do not change. I always use, a formula that I've used with my kids and everybody that I ever have worked with. And it's just for change, for C to happen, for change to happen. If you put the equal sign and equal to or greater than, or it's just equal to, use DFR. Dissatisfaction, fear, and resistance to change have to be so great that you're willing to change.
Yep.
You are at that moment in
Exactly.
time.
Exactly. Well, and again, I think that there are pros and cons to both models for people, because not everyone is equipped to run a business. Not everyone is equipped to drive their own, car.
Guidelines, rules,
I know.
technology.
I think the more we could, so we got to a point through all this regulation, which definitely had an upside. I think the ability to repay was brilliant, right? Like somehow, not the little tiny box where, you have to be no, I'm talking about just like in general, an ability to repay. Great. Let's talk about that. That should always be on the table. How are you going to repay your loan? But the point where we went initially after Dodd-Frank, where you're getting fined over a decimal point in the wrong place, or, something like that. And that's what drove this cost through the roof, and all these lawsuits over some minutia that didn't matter at all. So again, like at this point, lenders it's checkbox, right? Did I get that? Did I get that? Did I get that? And can I sell it? That's really all they care about. Can I sell it? Can I unload this thing and not get stuck with it? And have I complied with the guidelines so that when I get audited, not if, when I get audited, I'm going to make it through unscathed, or at least close enough to it to stay in business. So it's a tough spot, right? And you know, my concern for the brokers who, we talked about an instance last week where I was talking to a lender. They had a broker who had created an email account where all the disclosures went for his clients. And then he did it for them. And so he was objecting to them pushing back, saying, you cannot do that, and insisted he was right. He was so out to lunch. It was crazy. He finally, and they got into, I won't even tell you, I was dying though when I heard this story. Some words were exchanged that were fairly vivid. And then finally he went to his attorney, who said, yeah, you can lose your license. You know, it violates all your agreements you have with your wholesalers. You can't do that. Wow. Okay, that's great. He found out that way, rather than having an auditor come in and shut him down or fine him into oblivion or whatever. So my concern is that brokerages are very important in our market, but it's very important that everyone understands what the rules are and are complying with them. But again, this dries up your costs, and little guys have a harder time shouldering that burden than, you know, a bigger operation. And so how do we balance that out? That's why we're so focused on what information can we provide to brokers so that they are up on what is right and wrong and okay.
The other extreme is the big banks. They solely focus on compliance. They don't care about the customer. They don't care about closing on time. All they care about, are we compliant? Yes, move ahead. We're not, close the loan. Done. I mean, by close, I mean stop the loan. And it's like, that's all they care about. And as long as they're compliant, they're happy. And it's, that's the wrong focus either, because it should be, the focus should be on the customer.
And I think you find, so you're at that point, right, of where necessity change happens because I'm so pissed off. I want to, I've got to make some move here, right? And I think, so a couple things. I think the 30-year loan has proven to be maybe have aged out. So, and then if you really think about how we tackled affordability, because I think that the next big issue is going to be affordability, right? Because you got home prices that are here, right? So if affordability is what we're trying to solve for. In the old days, right, interest rates go up 300 basis points. What did we do? We offered an ARM, and you qualified at the start rate. Nobody even understood the ARMs. They didn't understand when they adjusted.
Even loan officers didn't understand it.
Nobody understood anything, right? Index, margin,
double toothpick,
right?
Bill.
Yeah, nobody understood it, but we immediately did that and offered a lower rate, right? So we stayed in the market. Well, you don't have that. So a 30-year fixed rate loan without a buy down, what do? And so the only way to solve this is to extend the amortization. So I see the next big product, right, being a 40-year. Yeah. I offered a 46.5-year loan at Ownit back in the day because it was interest only. You had a little bit of amortization. Once you move to 47 years, you have zero amortization, right? So what do you get in a 40-year AM? You get a lower payment, right? So I think what you're going to see is that's why the capital market to some extent is all messed up. You guys, we just refinanced everybody 3 times. So the average life of a loan, when I started into business with I still have it, a Fannie Mae Gold Book back here, a loan was so old that it was in a book. And we had this thing that said, if you did this, a 30-year loan will last for 12 years. And everything in our business was based upon a 12-year prepay speed.
Right.
And that equaled an 1/8 or whatever, right? In terms of how you measured pricing. So today, you have now just taken the capital market through a time when the average loan prepaid in 18 months.
Yeah,
And you're now telling people that it's going to last forever.
right.
Well, so if you're originating a 7% 30-year fixed rate loan right now, thinking that the market is going to come down due to a recession, how long is that 7% loan going to last?
Not long.
6 months.
Not very long. So
Yeah.
if you're an investor,
Why do you want to lend at
why
7?
would you lend at 7%?
Yeah, you know
Okay,
it's going to come
and-
off the books really fast.
So my point is that 30-year loans already don't fit a customer very well because they keep refinancing it, obviously, because they need the equity out. So you should either make them portable or expandable and contractible or something. But my view is the first thing that we're gonna have to attack is to extend the term. So I bet you, and I'm working on it as well, you're gonna see a 10-year IO with a 30-year fix behind it because it has to be safe, which will be a 40-year AM total.
Right. Well, I would rather
Right.
see that than going to a bunch of adjustables, which is a problem in Europe.
Not gonna happen.
Right.
Yeah, it's not gonna
don't-
happen.
Well, I mean, think about it. So when the European bank raises their rates, everybody's mortgage rates go up
Yeah, take
3/4 or a half. or
Take
whatever.
Canada, right?
Overnight.
Everybody's up 3. Yeah, you're
Yeah,
up
so-
3%, 5%.
So our loans probably saved us to some extent right now, just because, and it will keep us from having some big crash, because you're not going to have people. I mean, because if you go into a loan expecting it to be, like what European Central Bank hadn't raised in 11 years or something,
Yeah.
or was that,
Yeah.
was that Britain or anyway? The point being, they think, oh, here's my rate, and poof, in overnight it's up 3/4 and another.
I don't think America will ever go to the shorter term bullets,
I hope not.
right? It's never, I don't think it fits. And the capital market doesn't like it. It's just like you guys were saying, why is the spread between a treasury and a mortgage back so wide? That's why.
Mhm.
Right.
And it will
Yeah.
solve itself as interest rates have hit this tipping point, because I do think it's hit. I mean, look, it's unsustainable at 7.
Right.
It's going to be at 6. It's going to be at 5. It's probably going to get to 4, right?
You really
It's
think
never
that's
going
right?
to 2.
We're not
Right?
hearing more from anyone else. That's interesting. And people do not count on that. I mean, it is what it is, right? But we have come down a point a month. So,
Yeah.
I mean, that's
I'm
fast.
watching it right now. I'm looking at the market right now. And I think the message that I would say to, if I'm a loan officer and I want to go out today and I want to talk about things that are potential, that could help you. You have a lot of, what'd you say, 56%? We have a ton of equity, tappable equity. I guarantee you everybody's thinking about how to tap it.
Yeah.
And nobody wants to pay 9.
Yep. Yeah.
So I want to give you 2 options. I'm going to give you a shared appreciation. Let's talk about it. Let's talk about an HEI. Have you ever heard of that? No. Okay, let me talk about that opportunity for you. And if you're over 62 or over 65, you should talk about a HECM.
Yep.
Because neither of these have any payments.
Right. Right.
No payments.
We have another comment from somebody who said that a major problem in California is people that are moving up are getting killed with new property taxes, and that's what's hurting people. And they said Prop 90, I'm sure they meant Prop 19,
19
has been a dud. 19 was a dud. It was ridiculous, and they're trying to roll it back. But it's but I will say, I mean, at least here, if you stay in your house, at least you're safe. It's the places around the country who don't have that in place, and all of a sudden they appreciated 30%. You're getting a tax bill this year. I mean, I keep waiting to hear the screams happening on that, because how do you pay? How does that work into your budget?
Well,
Right?
and I do think it's an interesting point too, because one of the things that we worked on at Finance of America, and so not only did we do about 35% of our business at Finance of America were securitizations that were private. So 65% of what we did went to the agencies, right? So we did our own jumbos, we did our own reverse, we did our own fix and flip, and we did our own non-owners, and some of that we securitized ourselves. So when you move to that world where you're actually providing and working with investors, who want to buy mortgages. You learn a lot about their view of default risk, affordability, and all the things that we're talking about. And I think the nuggets that you pick up from there is that we need, the only thing that I think that is wrong is we need to stay focused on products that offer solutions for self-employed,
Right.
roommates, rental, and other income options. And we need to count your income potential,
Yes.
not your historic income bonus.
Yeah, thank you. That would be a brilliant,
Because
what a novel
I mean,
idea.
if I get a verification and the verification says, I mean, because look, what's happened over time is that gross income used to be almost all in base pay.
Right.
Mhm.
Now gross income is skinny base with all this bullshit around, okay, I maybe get a bonus, I maybe get overtime, you look at a paycheck stub, it's like freaking confusing. I
Mhm.
mean, it's got like 70 deducts from it and different things happening. So I think what has to happen is if I have an employee, and everybody wants benefits. So I've got to have benefits. So I've got to be employed, and I want to be self-employed. So I have this other gig
Yep.
thing that I'm doing.
Yep.
I need to be able to count that income, right? And if I can count that income, and all my kids, I mean, you guys, I have 5 children, all of them, save one who just got married and had a baby, owns a home.
Mhm.
What do I do with all of them? They all own houses where they rent a portion of that.
Yep.
And that is their safety net.
Yes.
They rent the bottom side of their house for as much as their mortgage payment is, and that sustains them.
Right.
In all of this crap that's happening
The
to
ups and
them
downs.
as young.
Being in San Francisco, people always say, how do people afford these crazy homes? I go, well, my average tax return, I've got a good W-2 job that's got some bonus or commission. Then they also have the side gig, the Schedule C. Then they usually have an LLC that they've got going also on the other side. They have some rental property, and it's like, and then they have something they're Airbnb out, or so they've got all these other schedules. Like, yeah, they usually have the Schedule E, and it's lined up, and it's like it's their own house. It's like
I've had borrowers who built an ADU and then they moved into it, rented out the main house, and they lived there perfectly happy.
brilliant. Yeah, brilliant move.
Somebody
Forget.
asked, oh, go ahead.
No,
What?
forget stock options. All the equity stuff that we can't count. It's like, so
stock options.
I don't think that it takes a quantum leap for us to take. We're real estate lenders in theory, right? We should be able to take income from property. And if you think about it, that's what I'm trying. So when I go out to investors who are what we call AUM buyers, people that actually buy mortgages instead of treasuries. So why would you buy a mortgage if you're an investor over a treasury? Yield is number one. And I don't see the risk, because the government risk at a treasury is like, okay, is the government going to fail? Probably not. So
Right.
when we look at us in mortgages, okay, the mortgage could fail. How could it fail? What is the LTV? And so when you start thinking of that, it is all the things that you all are good at, which is trying to not put people in. We don't put people in. I mean, look, naturally speaking, a renter doesn't rent over 50% of their gross income. They just don't, because they can't afford it.
Right.
And a homeowner doesn't generally get over 45 or 50 DTI. That's before taxes. After taxes, it's going to be lower, just naturally. And so absent fraud, this is a great business, and it never goes into default. And even back in the Great Depression, when you looked at when the Treasury did its analysis of 2006, 2007, and 2008, 92% of everybody paid.
Yeah.
Wow. That is
Eight
nonsense. the information.
It's
that we were-
only 8%. Now, what was the problem? The 8% went all the way to foreclosure,
Yeah.
Right.
and it
Right.
never did before.
Which,
Right?
which the servicers are tasked with, please, you better.
Oh my God, servicing cost is like, I'm recording. You're on a recorded line. Do you
Yes,
know that it's like, are you kidding me? I just want you to fucking handle my forbearance. Right?
there
Could you
go.
just listen to me? I can't figure out who I'm paying. Somebody help me. Right? Well, no, you can't. They won't help you.
Someone asked for an explanation of FUBAR, and
Fubar.
and
Unfortunately,
it
They have
is,
to look it up.
well,
no, it's,
basically
I'm
it
going to
is-
use freaked up, but it's fucked up beyond all recognition.
okay, yeah. I was gonna say messed up beyond repair, but close enough. Okay,
Yeah.
moving right along. So somebody made the comment, the Texas no cash out theology goes back to the carpetbaggers that stole homes, farms, and ranches after Civil War. Not a new issue there, which I thought, I didn't realize that was the history
Well,
of.
I think that's a little bit true, but it's mostly true what Kevin said, which is the boom and bust of Texas created hey, we got to be careful in our state because we bust so often.
Yeah,
Because they basically
California never busts.
Well, California
I mean,
is so diverse in its industries versus Texas was just basically oil. Now they're venturing into technology, but that was one of the reasons for it, and that's one of the reasons why California stays so strong. Is San Francisco, we have like 5 different major industries that are all the main ones, all hitting on all cylinders.
Well, and I was gonna add to what Audrey had said before. One of the things that is coming from investors on the other side is this. So the DTI is basically gross sum income analysis in your DTI, your debt to income. I actually see a movement because of climate change and because of insurance costs and maintenance costs, water, your electric grid, insurance, all those things are skyrocketing. So I think you're going to see a movement probably with investors trying to go away from DTI and more to residual income like you do in a VA loan.
well, we had suggested that. I think it was, I don't know whether it was my presidency or Kevin's presidency, but was it I don't know. Camp wrote a letter to CFPB suggesting that we move away from DTI and focus on residual income because it's a better indicator whether you're going to be able to afford something. So I want to take just a moment and you've mentioned Finance of America a few times, and we've talked a little bit about companies going out of the market, and there are companies coming in as well. What happened at Finance of America? Why are they gone?
Finance of America was a unique strategy in that it was acquired, and they acquired my business, Skyline and NewLeaf, and my technology business, Cloudvirga. So it was built by Blackstone and a guy by the name of Brian Libman. Very unique people, deal centric, and about 20 plus acquisitions. So it was an acquisition business. And what we were trying to solve for overall in the company was, how can you build a business that can handle the cyclicality of mortgage? And our view of that was you had to have multiple streams of income. And in our business, we had 5 businesses, of which FAR. So we had FAR, we had a reverse business, we have a fix and flip business, we had a forward business, and in the forward business, we did consumer direct, retained servicing, retail, wholesale, blah, 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 in that business. Then we had a securitization business, and we had a business that made money off of all the mortgages that we did. So we owned what I would say would be a services business, right? So those 5 income streams pretty much balanced out what we see. The problem, and so they exited forward because they didn't need forward to do what the things that they're doing today, because you saw they just announced they bought AAG. So they're going to double down in reverse. They've got a great fix and flip business. And the other businesses are performing, and they were getting destroyed in the market by their association with Forward,
Wow.
right? So their stock, we were a public company, right? So our public stock had gone from $10 to $2. And a lot of that was just because all of mortgage was thrown into the trash bin, all of Forward mortgage. And if you look at our competitors don't have these businesses. They're all in Forward,
Right.
right? So that's why.
So to save the rest of it, they got out of Forward.
Yeah, they just didn't feel like they were committed to it. And they're better at creating products and services through these other businesses in a TPO or wholesale way.
Mhm.
And I think that was why. And companies, and there are the smaller independent mortgage banks, I think, focus only on Forward. And one of the challenges that I've always had being a mortgage banker is this wacky
Of course.
thing that we go through,
All
right?
of our
So,
challenges, Bill, all of our challenges.
and one of the challenges that I think you have is that mortgage thinks that the macro hedge to Forward mortgage is servicing. Well, it isn't. It is and it isn't, because you really can't afford to retain servicing if you have to price to current market. And yet over the last couple of years, we were able to, some of the smaller banks mortgage banks were able to retain servicing, but it really isn't a macro hedge. It's just another income stream. And so we tried to figure out at Finance of America, how do you build a company that can withstand anything? And I think we have to some extent. It's just that personally, I would have kept Forward. I left in March. They closed Forward later in the year. I think some of that is just a commitment to it, plus a leader for it, right? Is it really what you want to do? And you guys know, this is a hard freaking business.
Yeah, very much so.
Right. And you've got to really want to be in it at all times. And sometimes it's just a very hard business to love.
Yeah. Yeah, you know what? It's a hard business.
And I love it.
Oh,
I mean,
I love it
if you
too.
don't love it,
So do
if
we.
you don't love it unconditionally,
Yeah.
you might as well shoot yourself in the head.
Yeah, exactly. All right. So as we get to the end of the hour, if you were to give one little bit of advice to people in this market, it's December, I mean, hello, I was telling you that we did a session with Coach Katie a few weeks ago, how to build, keep your momentum during the holidays. And I was laughing, like, a lot of people in our industry need to get some momentum going again. They just let it all go by the wayside. And so what would you suggest, like, number one thing for getting yourself
2x activity.
2023? What?
Yeah. So 2x activity. So double your activity with your customer base, and double it, meaning I am doing twice. If I spend X amount of time calling my customers, I'm now doubling that.
Okay.
I'm holding seminars. I'm going to events at camp. I'm learning about products. I'm doing everything. I guarantee you guys that if you double your activity, you will be just fine, right? With your customer base.
Some people have no.
And I think Coach Katie is all about just, and that's what one of the things is that I think one of the things we instituted at Finance of America, and I've done with all my loan officers and all my branches forever, is create a plan, right? So we have what we called a one-page plan, an OPP. And so what we did with all of our LOs is we forced them to sort of go through, what is my plan? And the plan begins with activity and doubling that activity. It didn't, yes, I want to do my volume numbers and I want to make X dollars and I want to do Y, but if you don't have activity and you're not adding to your database, I think the other thing that we found was connecting back to all your customers. So with total experts of the world, boomerangs of the world, mortgage coaches of the world, all of that that's available to you today, you have to have conversations constantly with your database of people.
Yep.
So, and that's hard to do, right? Legally. And so you have to do all of that compliantly. But I like products that create, I mean, I love product like FinLocker that they have, which is a mobile app, which is focused on sustainable wealth and incubation of a customer and staying connected, but it's mobile, and I could brand it. I like products that like Homestack that realtors use, where they give the multiple listing service to a customer, but it's my mobile app, right, where they're seeing me all the time. And then I like doing seminars. I
Great.
like actually going out and saying, and I would say, okay, if you don't know anything right now today about an HEI, a home equity instrument, understand it, because you've got an historic amount of equity and people who don't want to make payments, right? How do I connect those two dots? And so I spend a lot of my time just looking at products and services and just thinking about it like you guys would. What is unnatural about all of this? That is unnatural, because I am not going to take out equity and pay 9 and do a HELOC and have a payment.
People
But
are
I
doing
might
all day
do,
long.
I might do a shared appreciation
Right.
with an
Maybe.
investor with no payment and have a partner who sits there for 30 years and then I can use the money. And so I just think products, it's a good time. I guess it's a great time to have those conversations with customers, because there's a lot of money in confusion. And your job is to really be the straight line that's helping people manage this contradiction, right?
Yes.
Because it's just a contradiction. My wife says all the time that she doesn't, with our kids or with other couples that we try to hang out with, the thing that drives her crazy is really the inconsistency in people. And if she sees inconsistencies, like they act one way, they talk another, they do something, right? She just goes, I just can't stand it, right?
Yeah, be
And
consistent.
I think this market is massively inconsistent.
Yes.
And there's a huge contradiction that has seized everybody up. Guys and gals, you guys want to make sure that you are ready for the boom as these people unseize up, because they are going to act. There's too much equity.
Yeah.
It's just going to be like travel.
Yeah.
Yeah.
People are going to travel all over the place once they figure it's safe and I can go. Well,
Right.
That's all COVID did, was stove us up and create this equity and this anomaly. It is all going to happen, and you're going to be the beneficiary of it.
We've talked about that. The MLS searches are off the charts. The
Off the
pent-up demand
chart.
is there, they're just waiting. So we are going to leave with one last thought. It comes from Dirk Nelson, who we love.
Dirk.
Yes, action becomes before motivation. Let me say that more clearly. Action comes before motivation. So just because you don't feel motivated doesn't mean you don't do something. You have to start
Don't do
before
it.
you feel like starting. So there you go. So with that, we're going to wrap it up. Bill, thank you so much for joining
Thank
me.
you,
You
Bill.
guys.
Great.
Good to meet you
We
both.
look forward to
Spend
seeing
time.
you next Tuesday at 11 a.m. same time, Pacific time.
And the
wherever
Down
you
and
are
Dirty
around the
coming on
country.
Thursday.
Pardon me?
Down and Dirty on Thursday.
And the Down and Dirty on Thursday with ARC. So we will look forward to seeing you all there. Have a wonderful week. Do the call to action. Have a wonderful one. Mwah. Bye, guys.
Merry Christmas, y'all. See y'all.
Bye.
Thank you.